Distinguish between forfeiting and factoring. Forfeiting was developed to finance medium to long term contracts for financing capital goods. It is now being more widely used in the short term also, especially where the contracts involve large value. There are specialized finance houses that deal in this business and many are linked to some of main banks. This is a form of fixed rate finance which involves the purchase by the forfeiture of trade receivable, normally in the form of trade bills of exchange or promissory notes accepted by the buyers with the endorsement or guarantee of a bank in the buyer's country. The benefits are that the exporter can obtain full value of his export contract on or near shipment without recourse. The importer, on the other hand, has extended payment terms at a fixed rate finance. The forfeiture takes over the buyer and country risk. Forfeiting provides a real alternative to the government-backed export finance scheme. Factoring can, however, broadly be defined as an agreement in which receivables arising out of sale of goods services are sold by a firm client to the factor, a financial intermediary, as a result of which the title to the goods services represented by the said receivables passes on to the factor. Henceforth, the factor becomes responsible for all credit controls, sales accounting, and debt collection from the buyer. In a full service factoring concept without recourse facility, if any of the debtor fails to pay the dues as a result of his financial instability, insolvency, bankruptcy, the factor has to absorb the losses. Some of the points of distinction between forfeiting and factoring have been outlined in the following table. Factoring may be with recourse or without recourse to the supplier. Forfeiting, this is without recourse to the exporter. The risks are borne by the forfeiter. Factoring is usually involves trade receivables of short maturities. Forfeiting is usually deals in trade receivables of medium and long-term maturity. Factoring does not involve dealing in negotiable instrument. Forfeiting involves dealing in negotiable instrument like bills of exchange and promissory note. Factoring, the seller client bears the cost of factoring. Forfeiting, the overseas buyer bears the cost of forfeiting. Factoring usually it involves purchase of all book debt or all classes of book debts. Forfeiting is generally transaction or project based. Its structuring and costing is case to case basis. Factoring tends to be a case of sale of debt obligation to the factor with no secondary market. Forfeiting, there exists a secondary market in forfeiting. This adds depth and liquidity to forfeiting.